By now, you've all heard the news. The Fed's cut the interest rates again. I'm starting to get a lot of phone calls asking, well, how much have the mortgage rates went down? Did you know there's a difference between the Fed's interest rates and mortgage rates? Do you know how the Fed's interest rate cuts affect mortgage rates? Let's talk about it. Hi, my name is Billy Bryson with Bryson Team Real Estate and Home Loans. If you're new to my channel, please make sure to subscribe, like this video, and please leave a comment below. Also, if you or anyone you know is considering making a move or refinancing, if you can please give me a call, pass on my number, or you can visit my website for free, helpful real estate and loan information. So back to the topic on how the Fed's interest rate cut affects mortgage rates. First, let me start by emphasizing the Fed's cut the interest rates, not the mortgage rates. And Fed's reduced its key short-term rate, which influences many consumer and business loans and the overall economy. The Feds lowered these interest rates in order to stimulate economic growth, as lower financing costs can encourage borrowing and investing in the stock market. This short-term key rate is one at which banks and other financial institutions loan money to one another. When the rate decreases, it becomes less expensive for banks to borrow from other banks, and then those lower costs are then passed on to consumers. They're passed on to consumer in the form of lower interest rates on line of credit, auto loans, and adjustable rate mortgages. However, this doesn't directly affect long-term rates, which include products like the 30-year fixed mortgage. One thing sometimes homeowners misunderstand is how the Federal Reserve affects traditional mortgage rates. Traditional long-term 30-year fixed mortgage rates are influenced by several factors, including buying and selling of securities such as bonds and treasury notes. Investor demands for these treasury notes and bonds is what affects the 30-year fixed rate mortgage. Mortgage rates are determined mostly on the secondary market, where mortgages are bought and sold. Investors usually turn to these when the economy is unstable and they want to take their money out of the stock market. So when the Feds cut the short-term rate in order to stimulate economic growth, it can actually be worse for the 30-year fixed rate. Because as the economy is getting better, more investors feel safe investing their money in the stock market as opposed to treasury notes and bonds. So in short, when the Feds cut the interest rates, it does not have a direct effect on the mortgage rate, but it does have an overall effect on the economy, which does affect the mortgage rates, either positive or negative. Hopefully this all makes sense. I know it can sound confusing, so if you have any questions, please feel free to call me direct. I'd be happy to explain more in detail. Once again, my name is Billy Bryson with Bryson Team Real Estate and Home Loans. If you or anyone you know is considering making a move or refinancing, please give me a call, pass on my number, or you can visit my website for free, helpful real estate and loan information. Thank you guys so much for watching. I hope you found this information helpful and insightful. So please make sure to subscribe, like it, and share it. Have a great day. Thank you very much. Bye-bye.